Solutions. The presentation is going to take approximately 30 minutes, and what we're going to try to do is leave a block of 15 minutes at the conclusion of the presentation should you have any questions. If you do have questions during the presentation, feel free to send them in anytime, or feel free to send them in at the conclusion. We'd be happy to answer them. If you go into your there's a little tabulation box in GoToMeetings. There's a chat section, and if you simply type your questions into the chat section, we'll be able to adequately answer them at any time throughout the broadcast. So with that said, we'll go ahead and get started. My name is Bill Devers. I'm an account executive, the exclusive account executive at Sightlines for Small Campus Solutions. I will be administering the first half of the presentation, and Nathan Webb will be conducting the second part of the presentation. He's an associate director at Sightlines, and he's really the brains behind the creation of our small campus solution. So again, we're here for questions. We're here to answer anything that might come to the table for you guys, and you can contact us at any of the information listed above. On this call, we'd like to have a chance to really introduce Sightlines, show how our data sheds light on some of the key challenges facing facilities management, detail how our new small campus solution helps institutions create dialogue and overcome these challenges, and finally, we want to discuss if there's an opportunity for us to work together in the future based on today's overview. In the overview section, we're going to discuss who we are, how we help higher education institutions. We'll lead off the discussion discussing our ROPA Plus, which is our core comprehensive facilities intelligence solution, and we'll also give you a brief introduction to our background, storyline, and client base. And just for your reference, ROPA Plus stands for Return on Physical Assets. Sightlines is a facilities advisory firm. We work almost exclusively with higher education institutions. We use a common vocabulary and consistent methodology to deliver our services. Our work helps institutions document trends, separate fact from fiction, and identify ways to use resources more effectively. Sightlines helps you tell a story to create a consensus on your campus for change. No one else in the industry can help you measure key metrics, but we can through our intelligence of data and solutions measurement. ROPA Plus, again defined as a return on physical assets, is our core service that helps you measure, monitor, and benchmark facilities performance on an annual basis. What we do is we provide a 360-degree view of your physical plant, asset value, resources, and risks and opportunities. Sometimes, however, you'll need to dive deeper in a particular area of your facilities management, and as a result, we have strategic facility solutions that add more in-depth analysis to those certain topics. We have a buildings portfolio solution, which assists in defining deferred maintenance and facilities needs, as well as developing multi-year capital plans. Our space utilization solution helps institutions optimize their educational space, and our sustainability solution helps you analyze and maximize your energy and carbon emission reduction goals to help you fulfill various reporting requirements. All of these metrics tie into our extensive client membership database. Sightlines serves 450 institutions in the United States and Canada, including over 325 ROPA Plus members. You can see a breakdown of our membership, including flagships, public institutions, private institutions, state systems, and campuses large and small across North America. The growth of our database, experiences, and knowledge of best practices has been the engine behind our insights, national thought leadership, and impact on campuses. Several key metrics demonstrate the depth of our database, including a total of 450 campuses, 1 billion in gross square footage, and over 15 billion in capital and operating budgets, plus the operating metrics of 40,000 buildings and approximately 50,000 staff. Over the last 2 years, we've added over 100 new campuses to our membership and database, so the facilities intelligence tools we provide become more powerful year over year. Our extensive depth and background now leads us into a discussion about key challenges that you guys face in facility management today. As I just stated, there's several glaring challenges in higher education today. In this section, what we're going to do is we're going to discuss the challenges in higher education, highlight the disconnects between institutions and facilities, outline the 4 major life cycles in construction to really give you an idea of where you fit in our spectrum, and we'll also show you how to change the conversation and create a common vocabulary and rigorous process for your facilities management that can be articulated from the boiler room down all the way to the boardroom. Since the recession, many experts question the sustainability of higher education. There are a number of issues that are converging really here and clashing at the same time. Government aid for education has fallen drastically. Administrative support costs have grown compared to education costs. Enrollment, as everyone knows, has been declining in many regions, and pressures are more significant, especially in particular with smaller campuses, on both operating budgets and capital budgets due to the sensitivity of fluctuating enrollment. This disconnect really directly speaks to the reason why Sightlines was founded. And we have a quick story here that I want to share with you guys to add some color and insight to that. We went to our first conference in 2001 called ACUBO. ACUBO has a diverse membership of nearly 1,000 institutions and organizations in support of instructional research and public service missions of higher education. ACUBO really exists to promote effective and ethical businesses and financial administration in colleges and universities in the eastern region of the United States. At the conference, we asked a room full of business officers a few simple questions, such as, how many of you in this room know your value of your endowment? How many of you know your return from last fiscal year? How many of you know your draw rate? And almost everyone had their hands raised. But when we asked how many of them could answer the same questions about their facilities, everybody remained quiet. Some of those questions were, what is your replacement value? What's your deferral rate? What's your backlog? Not surprisingly to us, at least, almost all of those hands went down. Higher education administrators have rigorous tools for managing endowments and financial assets, but unfortunately not really for facilities. And at all but the wealthiest institutions in the country, facilities are worth 4 to 5 times that of endowments. And as campuses really continue to grow, this multiple is only going to become greater. So at this point, you're probably asking yourself, why are these tools more important today? Well, it's because today something unique is driving up capital needs. What you see right here is what we like to affectionately call our camel chart, and it represents root causes of one of the challenges in higher education, the aging campus and growing deferred maintenance. What we did here is we plotted the construction date of all the square footage in our extensive database. And you can see the 2 major humps as I explained before. The first hump shows the post-war campus construction that peaked in the 60s and 70s, in which 40% of space nationwide was constructed. We all know these buildings were very often built with lower quality construction, requiring significant repair. And this wave of buildings neared its first keep-up cycles when minor life cycle needs and finishes became due approximately sometime in the 80s. However, we didn't stop building for long. As you guys know, there was a second wave of campus construction that hit in the late 90s to mid-2000s. And these spaces tended to be of better quality overall, but more complex with higher tech controls and better finishes. The problem is that both of these groups of buildings are crossing thresholds at the same time. The post-war buildings, as you can imagine in the first camel hump, are now nearing 50 years old, and that's a period when major systems require replacement. And the complex buildings in the second camel hump are nearing 10 to 15 years of age, a time when space approaches their first round of renewal upkeep. Essentially, the catch-up needs of the older buildings are competing with the keep-up needs of the newer ones. And this is a major contributing factor to the alarming growth in facilities backlog. As a result of those converging needs that we just discussed, facilities backlogs are naturally on the rise. Nationwide, facilities backlog liabilities are approaching the $100 per gross square foot mark. But you're probably asking yourself, why is this different today? Well, in the past, institutions had many levers to pull to address these challenges. For instance, they could increase enrollment, raise tuition, borrow money, You could appeal for state support, spend part of your endowment, and in the past, many institutions did many of those things. But schools can no longer pull those same levers as before. As we talked about before, the number of high school graduates is level or declining in much of the United States. Tuition has outpaced inflation every year for 30 years. External funds like debt and state aid are no longer as readily available as before, or simply just harder to achieve, so you can no longer rely on additional expenditures. And to top it all off, capital budgets have not regained ground lost during the recession, and inflation has reduced the purchasing power of those operating budgets on campus. So the question really here is, what can we really do to alter and even the playing field? Clearly, the start to all of it is we need to change the conversation. The cultures of facilities has changed. Today's facilities organizations are asked to do more, be more, and have a seat at the decision-making table, given that you manage the institution's largest asset. This requires you to have better, more credible information at your fingertips. So, what if you had tools for facilities management, just like that of endowment managers, that would help you change the conversation on campus? With those tools, facilities would be treated more like a core business at an institution, where you'd be able to make more informed, data-driven decisions. You'd be able to align facilities with capital investment and mission and finance, and you'd be able to use predictive analytics to focus on outcomes and not necessarily those inputs. How do you make a case for this change? You start with a common vocabulary that can be articulated from the boardroom to the boiler room and consider key strategies for success. This leads us back into our core service, which is ROPA Plus, Return on Physical Assets. Our ROPA Plus process relies on 3 distinct concepts to go from data to insight. The foundation really is our discovery process. We collect base data here and use expert knowledge to learn and paint a picture of your campus. And we teach a common vocabulary and put your performance within that context. We also use predictive analytics to identify future needs and risks, as well as to establish long-term goals for improvements on your campus. We set up tools to monitor that performance and rebalance our plans and change as they evolve. The process helps create a common vocabulary for our measurement. ROPA really focuses on 4 separate but intrinsically related buckets of facilities metrics. The first 2, which are annual stewardship and asset reinvestment, are more capitally focused. Annual stewardship looks at what is needed on your campus to keep everything running properly on a day-to-day basis. This is known as keep-up costs. Asset reinvestment looks at what is needed in regards to your backlog of need and investment capacity to meet that need. Sounds departments, examples such as are they adequately staffed? Do you have enough superheroes for their job? We'll also look at the facilities operating budgets and energy. We'll walk through and still an important metric to measure for campuses. We came to the conclusion that a capital small institutions like yours, through extensive market research, we discovered that your needs were very different. The operations components less important than the annual and future investment strategy. Our capital focused solution is really what we like to call our small campus solution. Our new small campus solution focuses on your most pressing facilities questions, such as how do our physical profile affect our investment needs? How much should we invest in our facilities annually? Have our historical investment levels really been on target? Have we performed relative to our peers? How can we manage facilities risks most effectively? And how do we demonstrate a credible investment plan to institutional leadership? We again scaled down our ROPA Plus solution to have more of a capital focus, and again, it's what we like to call our small campus solution. So let's take a look at the solution in greater depth here. Our small campus solution, again, is a rigorous toolkit to help you overcome challenges and make better data-driven decisions about capital expenditures and long-term strategies for capital reinvestment. What we do, how we do it, and how we deliver value to our clients. Our small campus solution is based upon the same three core concepts that drive the ROPA Plus service. Discovery is where you're going to learn about your prediction of future risks and needs, and performance, where we're going to track progress towards you becoming an institution. For qualify, verify, quantify, to validate and interpret your data and present your performance. We broaden the context by benchmarking and comparing you against like institutions, which are similar to square footage and size components that you maintain. And these metrics then allow us to present it. What we do is we grant each campus membership to our member portal, and this creates a community of support throughout the year. So it gives you access to your peers, provides you educational content, and ongoing consultation, more importantly, with our team. Our member portal is currently being adapted to support the small campus offering, and the member portal really, like I said before, puts all of the data at your fingertips, and it's a super easy to navigate user interface. The customized dashboards that you'll see available in here will give you easy access to those facilities metrics that are most often used, and you can put these benchmarks directly into your homepage or create a custom dashboard that you can really go back into and revisit at any time. The benchmarking really now at this point, if you're a member, is only one click away, and you can gain easy access to knowledge and create peer measurement through your peers and to see where you stand. You can also use the My Story section to highlight and explore Sightline's key findings, and you can share and collaborate with your peers and take advantage of an interactive feature that makes it easier to engage with our Sightlines team. This slide right here is going to really show you a little bit about the process on delivering a small campus solution. And typically that takes around 8 to 10 weeks. What we do is we first schedule an online startup meeting so we can discuss the data and information required for your campus. We'll then collect 5 years of historical data for trending purposes. This usually takes around 3 to 4 weeks to collect, and then what we'll do is we'll process all that data. Again, if more time is needed, we can adjust to that, but this is just a general background. We'll then schedule a second meeting after that is completed in order to verify and qualify our findings and get a sign-off from the facilities people to make sure that your data is correct. With time to revise the finalized information, what we'll then do is we'll schedule a final presentation, and the audience is really to your choosing, but obviously we recommend key decision makers involved in this process who would be part of this presentation. At this time, what we're going to do is we're going to transition over to Nathan Webb, again, who is our Associate Director. And from this point forward, he's going to be administering the presentation. I'd like to kindly remind you guys that if you have any questions throughout the presentation, please feel free to go into the text box and put any questions that you may have in there. And we're also going to leave time at the end of the presentation to make sure that your questions are answered and we can address them then. With that away, we'll go ahead and send it over to Nate.
Great, thanks, Bill. Very happy now to show you a little bit more detail about the solution itself. And if you recall, Bill kind of walked us through a couple questions that we think are key to be thinking about. So if you haven't asked yourself these questions already about your facilities, we think this is a good framework to kind of start the thought process for you. And what we'll do over the next few slides is show you how some of our data and analysis can help provide some answers to these questions. So first thing we'll do is find your own version of the camel chart. So if you recall, Bill showed some really fascinating information about higher ed as an industry, but each institution is going to have their own version. So what we'll do is kind of take a look at your building stock and figure out where your construction is and how that might inform your risk profile. So this particular...
Hey, can I interrupt for a second?
Sure.
The screen seems to be black. I don't know, your slides don't seem to be coming through.
Okay. Okay, let's see, I'm sharing. Is it still black?
It is.
Okay, let's transition the presenter back to Bill. And Bill, if you can just advance the slides as I talk.
Absolutely.
And
so we're back on questions here.
Okay, and let's go ahead and move forward one more slide.
Okay, thanks, Nate.
Thanks, Eric. Okay, so for this particular, we put two sample campuses on this chart, and the first campus with the blue lines here is their version of their own Campbell chart, and you can see they have a lot of space in that post-war period built in the 50s, 60s, and 70s. So right off the bat, we could tell that this campus is really going to be in a reinvestment or catch-up mode, and that's going to have a very different set of conversations and recommendations as opposed to if we animate in the next campus, we can see their space profile is built a little bit newer in the modern and complex period. And so the conversation at this campus is going to be really about upkeep and stewardship and keep up to make sure that this campus stays ahead of the game, keeps up with their life cycles, and does not allow the campus to slide into a state of disrepair. So right off the bat, understanding individual campus age profiles helps frame the conversation moving forward from a capital perspective. And if we move ahead to the next slide, another way to look at your age profile is by kind of age bucket. So we look at what is your space under 10 years old, 10 to 25, 25 to 50, and over 50. In each one of those buckets, we can make an assessment of overall risk. So buildings that are under 10 years old are kind of what we call in the honeymoon phase, and they are kind of at a low risk period. And then as buildings continue to age, then more and more risk is brought into your portfolio. So one of the things we make a judgment is anything over 25 years old is considered to be at a level of risk, worth noting. And what we do is compare this level of risk at your particular campus to your peers as a group. And in this particular case, what we can see is that the overall risk is about the same between this individual campus and peers. However, the underlying risk underneath, you'll see that our campus here, as an example, has a greater percentage of space that's 25 to 50. And in that particular bucket is what we view as actually one of the highest risk buckets. It's got the highest operating costs and highest life cycle occurrences happening in this time frame. And so while the overall risk might look the same as peers here, the underlying risk tells a little bit of a different story. So again, this is just a nice way to use building age profile to set the stage for further conversations about risk and capital investment profiles. Moving ahead to the next slide, one of the things we do is help work through how much should you be spending on your campus. So the first kind of yardstick measurement is a 3% replacement value. This comes from NACUBO. It's kind of an industry standard, kind of a straight line depreciation model. But the problem is that it's not very realistic, it's not very detailed, and it tends to be too expensive for a lot of institutions to handle. So we've developed a proprietary model of looking at a life cycle analysis on your specific buildings. So we take a look at your building ages, construction vintages, building functions, technical complexities, architectural adjusters, and we adjust for your region, and we understand what's the life cycle need for your particular campus based on your particular building profile. And we divide that need between, if we can animate ahead, envelope and mechanical issues in blue versus space and program issues in red. So envelope mechanical issues you can think of as behind-the-wall type of needs as opposed to the red issues being kind of in front of the wall space and program type of issues. So a life cycle need is really kind of an equilibrium amount. If you were to spend ideally and replace every single life cycle on time, that would give you a life cycle target. or equilibrium mean. And then what we do is we go one step further and say, let's account for functional obsolescence. So knowing that your spaces, due to program and mission changes, will change and churn much faster than what the life cycle books tell us, we say, well, don't set aside all that money and plan for every single life cycle if you know you're going to change that space out before those life cycles come due anyway. And so based on our industry knowledge of working with over 400 campuses across the country, we've made some judgments to say, let's plan for 75% of the blue envelope mechanical behind the wall issues and 35% of the space and programming in front of the wall type of issues. And this gives us a more realistic target for you to achieve and strive for. And what we'll do is on the next slide, we say, okay, well, how has this target changed over time? Because we're always going to be changing a moving target. So not only due to inflation, but also when you add new space or renovate and reset the clock on spaces, you're going to be increasing bumps to your target zone. So if we look at the equilibrium as the top green line and then the target need as the bottom blue line, what that does is create an investment target zone. And if you're investing above the zone, you're actively decreasing your backlog on campus. If you're investing within the zone, then you're kind of treading water. You might be reducing some parts of the backlog, but you might be deferring in other areas, but you're kind of in a steady state. And if you're investing beneath the zone, then your backlog is growing on an annual basis. And then if we look at this particular example institution, you can see every year that we've looked historically in their profile, they have not met the zone, so that means that their backlog has been growing each year. Another important thing that we like to look at on this particular analysis is what kind of spending are we looking at? So we can segment spending between the blue bars, which is kind of annual institution recurring capital, versus the green bars, which is one-time capital, which tends to come in the form of gifts, grants, or bonds, and debt. And so what we like to understand is how much of a foundation do you have in recurring institutional capital in the blue, because that funding is dependable, it's reliable, and you can really plan for the future with that type of funding. As opposed to the one-time funds that come and go, it's really hard to plan 10 years out, let alone 5 years out, if you don't know how much of that capital is going to be available to you for facilities. So what we're seeing in the industry is a lot of folks, unfortunately, are relying too much on the one-time capital, and it creates kind of a roller coaster ride when trying to plan for the future. So our recommendations really are to boost as much as the recurring institutional capital as possible, get that as close to the bottom end of that target zone as possible to establish a good foundation, and then any of the one-time funds that come and go can put you over the top. So that's kind of a common recommendation and theme that we are talked about with a lot of campuses across the country. And that's certainly, I think, an important issue for small campuses as well. So moving forward, what we also like to do is understand, well, how is your investment profile compared to peers? And we do, this is where the benchmarking comes into play, and we can get some interesting insights here. So I take away 3 things from looking at this, where we have our sample institution on the left and our peer group averages on the right. The overall trending looks the same over the 7-year period. However, second thing to take away is that our institution is spending a little bit less than the peer group. So this is a situation where you might be falling behind peers a little bit. And then lastly, what I look at is, okay, looking at context of recent history, it looks like there's a cut after the recession in both cases, both our institution and peers. However, peers have done a better job of restoring funding after the recession at a much faster rate. So not only are peers spending more funds, but they're restoring them at a faster rate, which would really kind of cause some hesitation or some concern with this campus that they might be falling behind peers and having a harder time digging out of the recession. So this is kind of a good context. And if we move to the next slide, we can understand the implications of this situation. If you're funding below peers and not restoring quickly enough, then your backlog is going to be growing and surpassing peers. So that is the case at this particular institution. Their backlog is both greater than peers, but also increasing at a faster rate. So we can see kind of the cause and effect of underfunding and what that means to the backlog. We move ahead. What we do is use all of these analysis to really understand the discovery process. So understand where are we today, looking backwards 5 fiscal years worth of data, how did we get here today, and really understand that baseline and the trending and where you're headed, and use that benchmarking to establish context and validation. But then what we do is we use the prediction to say, okay, now we've looked backwards and looked at the history, now let's look forward and let's look to the future. So let's go ahead and move to the next slide. And what we can kind of do with our future prediction analysis is understand, okay, over the next 10 years, how much of your need is based on kind of just regular on-time cycle renewal versus what's your high-risk backlog of needs versus any kind of low-risk backlog. And then what we also want to do is understand over that same 10-year window, what's your anticipated funding level. And so what we can do is map that out on the chart on the right and understand, okay, when are your needs coming due, how much funding do you have, and do you basically have enough to cover it all. And in most cases, you won't have enough to cover it all. So really then the strategy and the conversation comes around, how can we understand where the risks are here and understand how we can maybe smooth this out or strategize and come up with some different modeling scenarios to create a 10-year capital plan. So in this particular case, if we just straight line the $20 million of funding over 10 years, you see $2 million a year. Well, it might be enough in the first couple of years. It's not going to be enough in the middle years. But what we can do in this next slide is show, well, let's put a little more thought process into this. We can see there's a valley in the renewal needs in the first few years of the program and in the out years of the program. So is there a way we can spread the backlog out over 3 years and front load the capital program a little bit so we can attack a little bit more of that backlog, knowing that we'll eventually have to be deferring a little bit in the middle and the out years, but also knowing that those middle and out years have projects that are a little bit of a lower risk profile. So really at the end of the day, we know you're going to have to be deferring in this type of situation, but what we're trying to do is say, let's be strategic and intentional about that deferral rather than letting that deferral kind of get out of hand and run its own course. So being very intentional about that can have a lot of value with institutional leadership. And if we move ahead, what we want to do is create that multi-year capital plan for you and track performance. So that's where the performance piece comes in. So we've looked backwards with discovery and set some trends and some context. We've used the prediction tools to look ahead and look to the future and ultimately create a capital plan. And then we use the performance piece to really track that. And what we'll do is identify the investment needs, look at that historical performance to understand how we got there today, look at the peer context to know if you're in better shape or worse shape or about the same as peers. That's always very helpful to know that. And then we use that predictive analysis to define that capital plan. And then ultimately the performance measurement says, okay, once we set that plan for you over the next 10 years, let's keep working on that year after year and understand how you're doing to plan. Are you meeting the investment mixes and the investment levels in that target zone that we set for you on an annual basis? And if so, kudos, let's keep it going. If not, are there some adjustments we need to make to the plan, or are there other folks on campus that we need to convince to help support the plan? We're always going to be there as a partner with you to go through that performance measurement on an annual basis. And finally, we just kind of want to share some value and return on investment type of discussion points as we kind of finish up the webinar here. So always, we want to help you make data-driven decisions. What we find on a lot of higher ed campuses is a lot of squeaky wheel syndrome. We want to try to break that cycle and really help you make decisions based on data. Having that independent third-party view is often very helpful to a lot of campuses. A lot of what we'll share with you is something that you probably already know and you probably already shared with your institutional leadership. But sometimes having that person from the outside support you in that conversation is very helpful. We're very accurate with our data and our future life cycles. You can have a lot of confidence in the credibility and the validity of the data we work with. We really look from a strategic standpoint, how do we try to optimize your capital investments? You really want to align all of your facilities investments with overall institutional mission and strategy, because you really need to have a strong constituency across all levels in order for these types of plans to really be successful. And then ultimately, we really do want to be setting goals and tracking performance. we don't want to just come in one time and leave you with a set of recommendations and then walk away. We really want to work with you on an ongoing basis and make sure that we continue to support those recommendations and track that progress. And really, at the end of the day, what really helps is our ability to help share a presentation with senior leadership. So whether it's the Board of Trustees or President's Cabinet, whatever audience you think would be best to help you convince your needs and convince the folks to support a capital program. We have a lot of experience presenting at that kind of a level, and frankly really enjoy that and really have a good track record of engaging boards and presidents and getting them on board with some facilities issues. And to that end, I'd like to share and end with a quote of a success story of a gentleman, David Provost, who's a senior VP at Champlain College in Burlington, Vermont. And you can see they're kind of a good small-sized campus. And you can kind of read through the quote. Our work with them was very well received by their president. Essentially, we helped their facilities group develop a kind of a capital reserve program. And the president was very impressed and actually commended facilities very well and said, well, you know, this is one of the first times I've seen facilities be a leader on our campus as a department and really set the gold standard for analysis and data-driven decisions. And he made a call to action that he wanted other departments around campus to kind of follow the same rigor and process to present capital budgets to the board. And it was a great success story, just one example here. And we'd love to hear some more about your campuses and work with you to find ways that we could help your particular campus with this kind of small campus solution setup. And so with that, I think we'll kind of end the broadcast of the information, but really want to open it up to questions and discussion. So with that, we'll go ahead and field some questions from the group. So it looks like we have a question. Does our analysis also look at IT infrastructure? So that's a good question, and unfortunately, we do not. So when we look at investment historically, we will track that information, but it's ultimately something that falls below the line from a benchmarking standpoint. And so we can do some analysis for you specifically, but we wouldn't have that peer benchmarking context. And then also when we do prediction of future life cycles, we really are focused on the building level. So the 6 kind of core main building subsystems that we look at would be roofs, building exteriors, HVAC, electrical issues, and plumbing issues, as well as interior spaces. So we really kind of are focused on the building level as opposed to IT. And I think we have another question about what's kind of the typical time commitment for collecting data for these type of solutions. And as Bill mentioned, what we're seeing is typically about a 3 to 4 week process between when we kick off and when we typically have all data in hand. And while the data collection process will be remote for our small campus solutions, we will have lots of open lines of communication. We definitely use this kind of a format, a webinar format, where we can look at data sources together and walk through the right kind of source of data, making sure we're pulling the right information from the right places. And so we really kind of support you in that data collection process. As you can imagine, working with so many institutions across the country, we've kind of seen good data, bad data, and everything in between. And so we have a pretty good eye and pretty good familiarity with some of the kinds of systems you might be using to help understand, okay, what kind of reports might you want to run to supply us with the data. So always, I think the first year of our engagement will be the most difficult to make sure we get all the right data from the start. But then what we're finding is that each year after that, as we renew and continue to work together, it becomes much less involved, and we kind of have a good routine and a good rapport, and the data flow becomes much easier after that. Any other questions from the group? Okay, looks like we have another one coming in here.
And on a side note, guys, that all these materials, the slides, the recording, everything we've gone over today are going to be available at your convenience for review. You should receive a follow-up email from us probably sometime tomorrow morning, sometime tomorrow afternoon, with all the logistical information and a recording from today's webinar. So again, if you guys have any questions, either today, sometime later after you receive the webinar, please feel free to contact myself or Nate, and we'd be glad to help.
Great, thanks, Bill. And I think just that last question came in was just to talk a little bit more about the deliverable process. And so just to reiterate, what we'll do from a deliverable standpoint is collaborate with you on building out a presentation. So once the data is all verified and qualified, we'll put together some of the initial storyboarding, and we'll kind of work on that with you together, get it all nice and tight, and then we'll ultimately come on site to do a presentation to an audience of your choosing. So again, whether that's with a CFO or a president's cabinet or board of trustees or a committee of the board, we can deliver that on-site presentation. That's all included as part of the solution. And then also all of the data, as Bill mentioned earlier, all the data and data templates and benchmarking and any presentations will all be posted to the member portal, which you'll have 24/7 access to as well. So as well. Okay, it looks like we don't have any other questions coming through, so I want to thank everyone for your time, and thanks for joining. This is kind of a nice way to introduce the solution to the marketplace, and we got some great feedback, and thank you for joining, and look forward to communicating with each of you hopefully in the future. And as Bill mentioned, if you have any questions, you can reach out to us directly. That'd be great.
Thank you all for your time.
Thank you very much, everybody. Have a nice day.